Good morning, good afternoon, good evening to our viewers. Welcome to the first episode of the Growthamped Wealth series. This episode is about unlocking wealth, maximize returns, and minimize taxes with King Operating's Scale It and Sell It strategy. I'm joined today by Rachel Griffith of King Operating Corporation. But before we get into the podcast, here's a quick disclaimer. This podcast is for educational purposes only. I'm not a financial advisor, CPA, or tax professional, and nothing shared here should be considered financial, legal, or tax advice. Please do your own due diligence and speak with your own qualified advisors before making any investment decisions. Also, if you are an accredited investor, this podcast is for you. So, welcome, Rachel. How are you?
Absolutely. Thank you so much. Thank you, Ion. I'm very excited to be here with you today and to all of your listeners out there on the Growth Amp podcast. Thank you so much for tuning in.
It's our pleasure to have you. Well, most accredited investors have seen plenty of deals that promise upside, but they still have the same three questions. How long is my money tied up? What and how much can I realistically expect back? And what does this mean for my taxes? So, with this in mind, let's dive in. Um,
Absolutely. Yeah,
all
Ion. I
right.
mean, most investors are looking for a couple components, right, with their investments in their portfolio. And they really want to see, of course, income generated, right? They want, either passive income or long-term growth. And what we really help focus on with oil and gas is not just those two components, but what we'll dive into in a little bit is also the tax component. We've seen a lot of interest and a lot more education out there surrounding what would be called tax aware investing or reducing your tax liability through an investment. And this is a little bit of a secret to some high net worth individuals or high income earners is really how do you offset taxes with your investment? And that's what oil and gas has actually provided for many, many, many years. And so, yeah, we're going to jump into it and talk more in depth about the tax benefit, but also what makes us different at King Operating and some interesting things about oil and gas to hopefully educate your audience out there.
Awesome. That was actually perfectly positioned for my next question, which is for those that are hearing about King Operating for the first time, what is this fund trying to do? And why is it different from the way people think about oil and gas investing?
Yeah, that is such a great question, Ion. So let's backtrack a little bit and let's go back to like 1980s and 1990s when we had some of the largest oil booms in the United States. And a lot of people got into oil investing during those years. Some of them hit it rich and some of them really did not. There was a lot of money lost. And part of the reason for that, the way that oil and gas was done, specifically oil during those times, it was a lot more raw. Technology hadn't really hit the scene in the way that it has now. The landscape in oil and gas drilling has changed dramatically through technology and basically through the understanding of how to do horizontal fracking. And just for a little bit of education for your investors out there, a lot of people they still have this idea of the dry hole, right? You're gonna hit a dry hole and you're not gonna hit any oil. And there is still a component of that in the United States if you're working with an operator that does exploratory drilling or wildcatting, or they're just hoping to hit it big in an area that's unknown. That could still happen. It's less likely now because of what we have with what's called seismic. And seismic is basically what goes into the earth and takes a giant X ray and it actually shows you underneath that basin what is there. Are there hydrocarbons there? What does the actual rock look like? What are they actually seeing? Versus in the 80s and 90s, they couldn't see into the ground at all. They were basically taking their best bet off of a couple wells that may have been drilled and they were hoping that they were going to hit and they were drilling wells that went straight down through source rocks like this. These are layers of what we would call source rocks and they're just hoping like a straw, right? If you put a straw into a layered cake, you're going to hit some of those layers, but you don't know how much and you're only going to get that pocket. So seismic and horizontal fracking really changed how oil and gas is done. It not just goes down, but now you actually see in the ground and you can watch your drill bit going through the actual source rock. You can track the entire thing to see how in zone you are. So at King Operating, we actually work in what is called developmental areas where we have data points from other operators that have been there. We take a lot into account, about 10 to 12 months of due diligence before we drill in an area. We use seismic, we have geologists, geophysicists, and incredible petroleum engineers that actually do horizontal fracking. And they've changed a lot of what was the major risk in oil and gas. So those are some I want to give your audience like a little bit of understanding about the oil and gas world. It's kind of mysterious out there. People don't really haven't had a lot of information. So that's a bit of the geology and understanding. Now, what makes King operating very different is that most traditional oil and gas operators, especially when they're working with what we would call accredited investors or high net worth individuals, or there's another term called a retail investor, they have been able to partake in oil and gas deals, but in what is the traditional model. And that means that you're going to invest in a producing well or a group of producing wells. Okay. And that's all you're going to really get. So you might get a tax benefit and you're going to get some revenue off of the well or the wells in that group. Now, the issue with that is that a oil well or oil natural gas, but specifically oil, is actually a depleting asset. It declines over time. And you hope that it has a steady decline curve, right? Usually when it comes on, we say it has flush production. A lot of that oil is going to come out of the ground in the first 6 months. And then you kind of hope that it steadies off to a nice decline curve. But what the secret really is that traditional oil and gas companies don't want you to understand, which is why, and we'll talk about this more, why our CEO, Jay Young, wrote the book called The Upside of Oil and Gas Investing, where he talks about this because he is a fourth generation oil and gas man. His family tracks back generations, is that there's a bag of goodies. I call it the bag of goodies in oil and gas. The bag of goodies means when you own lease acreage as an operator, you own this lease acreage. All of this has hydrocarbons, so you drill this well. This is called a proven producing well. Proven, and it's putting out X amount of barrels every day, and you can track the revenue that it's creating. Well, when you do this, especially in horizontal fracking, this well creates something else. And what it creates is on each side of it, two offset wells that can be drilled. And these are called proven undeveloped wells. Now, even by SEC standards, these are bankable assets. They know because of the current production that these could be drilled. They have an estimate on how much revenue they would produce. So this is the bag of goodies. It's the acreage, it's the producing well, and it's the offset wells that can be drilled for profit. So when you invest in traditional oil and gas, they don't allow you to take part in anything but that producing well. Why? Because they're actually going to raise more capital and then they'll come drill these wells. They don't really care that you have any of this. But for us at King Op, we scale it and sell it. So when we put this producing well in, we are packaging our J unit and we are actually allowing our partners to come in. They own their pro rata share of the partnership. They own the entire bag of goodies. Now we package this together to sell to private equity firms, larger oil and gas companies. That's how we get 2 to 3x multiple for our partners because they own everything in the fund.
Sure.
Does that make sense?
That for sure. So I think that definitely helps explain uh, the how the valuation and the future value of this at the time of exit would be determined. So
Mhm.
thank you for that very in-depth explanation.
I hope it wasn't too in depth. I tried to say high level with my very strategic and high profile examples here of the pen in the book for my geology.
No, it was perfect. On that note, how would this differ from real estate or other asset-based investment? If you wouldn't mind
Sure.
elaborating on that a little bit.
Well, we've seen a lot lately. There's a huge interest and a huge uptick in what is called alternative assets. Right. So an alternative asset is outside your traditional markets. And you have your stock markets and your bonds, your mutual funds, and all of that that lives within traditional markets, which a lot of people invest in. And then that's a lot of the bulk of their investment. But I would say in the last 5 to 10 years, we've seen a huge increase in alternative assets. And that's because the ultra wealthy in the United States have really tapped into this early on. They
Hmm.
probably have at least 50% of their portfolios in alternative assets. Now, that could be oil and gas, that could be real estate, it could be venture capital. You can lump in a little bit of crypto in there, but these are things that are outside the alternative, the traditional markets that actually allow for a larger opportunity for growth. And many of them have tax advantages. And just to mention this, even our model in oil and gas now, the upside, this is similar to the private equity model for anyone who wants to invest in oil and gas. They've done this model for a while, but they're putting in about 50 million, 100 million. So you can see how your normal accredited investor, well, unless you got 50 million to throw into a private equity deal, not going to happen
Sure.
for you. So yeah, there's a huge increase in focus on alternative assets like oil and gas.
For sure. I think you also talked about de-risking pretty well because this is
Mhm,
not exploratory and there's proven resources.
mhm.
Can you touch upon some of the locations that you guys are
Yeah.
actively working on?
Absolutely. So, yes, as you mentioned, one of the ways that we do de-risk our investment for our investors is that we work in proven developed areas. So that's the Permian Basin. We work in the
Uh-huh.
Bivens Ranch, which is 60,000 contiguous acres up in Amarillo that has already had some wells drilled on it there. And in the state of Texas, it actually is a proven oil field. So in Texas, it's designated as an oil field. And then we also work up in the mid-continent area, which is the Anadarko Basin. Literally hundreds of thousands of wells has been drilled in the Anadarko Basin over time. So these are high proven areas. And for our fund right now in COP3, not only are we in developmental areas, but we have 14 producing wells. So the last two wells that came on in October in that Bivens Ranch area, they already came online. They're already producing. It's not a question of are we going to hit oil? We've already hit oil. We're already producing and selling oil and natural gas, I should mention. And we're already sending out revenue checks for 11%, over 11% annualized distributions to partners. One of the ways we look at what is de-risking an investment is it in a developmental area? Have you hit oil? Is it producing? Are you sending out revenue for your investors? So that's where we're at right now, all those boxes ticked, which helps an investor kind of do their due diligence and assess how much risk they're taking on in an investment. There's some oil and gas deals where you're going to, put in your capital and it might not be deployed for a year or two
Sure.
years. So those kind of, make it a little bit more risky than what we do here, and especially right now in the current fund.
For sure. So, as with any investment, right? Could you talk a little bit about what the return profile looks like, what the monthly cash flow picture may look like, as well as the target hold period and why the timing matters?
Yeah, absolutely. Well, I would say, why does timing matter? I mean, right now, if you're watching this and it's April 10th, timing matters right now. And I won't dive too deep into this with what's happening geopolitically and in the Middle East, but we are definitely seeing what I would call the upcycle for commodity prices. All investments go through cycles. We've seen this. The stock market goes in cycles, real estate goes in cycles, crypto goes in cycles, oil and gas goes in cycles. And so, right now, with what's happened and what's been set off in the Middle East, has been a huge issue with disruption, the movement of oil through the Strait of Hormuz, now the shutdown of a lot of what production was occurring within Saudi Arabia, Qatar, United Arab Emirates. They've had to shut in wells. The Saudis they're down 600,000 barrels a day.
Wow.
The longer this is continuing, at first we thought maybe we're looking at a couple weeks of disruption, right? Maybe we're looking at a couple weeks of $100 oil. Well, that's now persisted for 6, 7 weeks. The longer that continues, the longer the transfer of disruption happens. And oil is a global commodity. It's not a US commodity. So anytime a global commodity has disruption, it actually affects us here at home. So I just say that about timing because we're looking, everybody I've talked to, macroeconomists, economists, you can look at Bloomberg, you could look at Goldman Sachs, you can look at the majority of anybody who's speaking to the situation right now. We're probably going to see increased pricing into 2027. Now, does that mean it's going to be $100? Maybe not, but nobody really sees it being below $80 a barrel into 2027. What does that mean for investors? Well, that's money in your pocket. If you
Uh-huh.
own oil and gas assets and you're a part of not a stock, I'm not talking about stocks. Stocks are doing a little bit
Sure.
better right now, but we're talking about owning those hard assets that are producing. When you're selling oil, it's based on that commodity price for the month. So $90 oil creates a much better IRR for an investor to receive cash flow. For us, as I mentioned, I'll use an example of what we would call one unit at King Operating, and that's a one pro rata share is $200,000. So if you had a $200,000 investment with us, you would be looking at, let's say last month was 11.4%. That was over $1,800. That's annualized. That's coming to you monthly because our distributions are monthly. So $1,800. And I want to mention that was at $60 oil. 1,800 at 60. The average from March is $93 a barrel. So that's going to be pure profit of over $40 a barrel for investors. So that's the distribution outlook. And then for us, of course, with the properties that we really have incredible assets right now in the Bivens location. These are high quality, high producing assets. And that's why when we look to eventually divest, we look for about a 2.8x. So I would say, that 2 to 3x marker on the 3 to 5 year time year horizon. So
Mhm.
shorter horizon time for an investment. Oil and gas investments are around 15 years, 10 to 15 years, because they're basing that solely on those wells producing. Where,
Got it. So yeah, this takes me into the an investor challenge, right? So
yeah,
most high income earners face significant tax burdens in their desire for passive income and a clearer exit strategies. In contrast, oil and gas is known for tax advantages, but many investors don't understand how these benefits actually work. Would you be able to break down these in simple terms and how they differ from tax treatment in other investments, whether alternative or conventional?
yeah, absolutely. There are some other tax you know, options for people to receive tax deductions in investments. Most people use real estate. A lot of traditional real estate. So if you're involved in a multifamily deal, then you're going to see a tax benefit based on passive income. There are some other broader ones out there like the easements that people use. And those were gone for a while. I think they're coming back. They've been a little bit of a sticky situation for the easements. So for oil and gas, it's one of the purest and cleanest tax deductions that is available to an accredited investor. And that is really because, well, I will say this in oil and gas, the tax deductions go back hundreds of years. But 1986, Ronald Reagan wanted to solidify this. And so he put it into law to increase and incentivize investors to help create US energy independence, right? They wanted to drill at
Sure.
home. We wanted
Yeah.
to see an increase in production. And so this is where he offered what's called the intangible drilling cost. And that intangible drilling cost is everything that goes into the ground to get a well going, right? Everything you can't see, everything that's not tangible. Now, Donald Trump in the big beautiful bill allowed us not just to use intangible drilling costs, but the tangible drilling costs, which used to go across, you would spread those out over 7 years. Now you can take them all in the bulk of year one. So for the tax benefit in oil and gas, it's not like a lot of real estate options which go against passive income. That deduction, it goes against active income, short-term, long-term capital gains, and it's taken usually in the bulk of year one. So if you invest in 2026, say it's April 2026, you're actually going to be able to receive retroactively all those deductions in 2026, which we usually average between 80 to 85% year one. And I hope I'm not talking too much. I feel like
No, this is great explanation.
I want to show your audience just an example, if that's okay,
Absolutely.
because I think it makes it such a stronger picture, a stronger illustration for them.
Yes.
Let me just pull this up so that anybody out there can kind of understand visually. And just to reiterate again, this is not like Rachel's idea of a tax benefit. This is not King Operating. This is IRS tax code. It is proven, it is clean, it is used across the United States. We'll give an example here, Ion. If you invested 200,000, right? That was your investment. We would be using this deduction factor. This is a modest deduction factor because this comes from King Operating. This is what we put into the ground for active drilling. This year 2025 was 83%. This is just modest. This is like the conservative outlook, right? We would take your investment and we would times it by our intangible drilling cost say 75%. So year one deduction, that's a $150,000 deduction, which goes on as a loss on a K1 that will be applied directly to any W-2 income that you have, any active income. Say you had a liquidity event, so you sold a piece of real estate. Now you have a capital gains issue. Say you sold some of your stocks. You have a cap gains issue. This is going to apply directly to your adjusted gross income. Then you're going to times that by your marginal tax bracket. So if you're 40%, might be higher if you're on the West Coast. God bless the West Coast people who are handing over their livelihood to the federal government, and say you're tired of doing that, right? You're tired of handing over so much money to the federal government. I mean, we love them for some of the things they do, but no need to tip them. That's what I always say. Got to pay them, but no need to tip them. That means for you, that is a $60,000 cash on cash saving. So it is basically over a 30% return on your money year one that you're keeping. Yep. That's what is so compelling and so strong. That's what draws a lot of people to the oil and gas space. But what I like to say is don't let the tax tail wag the investment dog. Does that make
Correct.
sense? Right?
Absolutely.
You want to do your due diligence. You want to work with an operator that has the right team in place, that has a track record, that's already producing, that's already sending out revenue to make sure you're also getting a solid investment.
For sure. Thank you for sharing that.
Yeah.
So the question that lines up right with this is, who is this most beneficial for in terms of your net worth individuals?
Yep, absolutely. So the individuals that are coming into the space that we work with, the majority of them are what we would call an accredited investor or a high net worth individual. Now, an accredited investor, some people think, am I an accredited investor? Because it almost sounds like you've had to take some
Mhm.
course or you had to complete something. It's really just a way that the SEC says, hey, you have a certain amount of net worth. You've produced a certain amount of income because you're taking on a little bit of liability in the sense of you're investing in an illiquid asset. And a liquid asset means that when we get your money as an investor, it's deployed immediately. It goes into the ground to produce oil and gas. So you can't just come and say, hey, like the stock market, I want to pull my investment out. Well, it's in the ground, it's drilling. You know what I mean? We can't go pull it out. The SEC wants to make sure that you're in a certain financial position to be able to take on that kind of liability. Even though we de-risk it, there's still liability in every investment, right? There's still a risk in every investment. Accredited means if you're married, that you can show within your W-2s that you've made over $300,000 for the past 2 years. If you're single, you've made $200,000 for the last 2 years, or you have a net worth and a bank account that can show that you have 1.2 million in assets. So that's basically how they determine if you're accredited. Now you can go to some websites and get letters that say you're accredited too, that is available, but that's kind of the overview on who we usually work
Got it. Perfect. What about pre-tax investments?
with. Yeah, that's a great question. Just to kind of give a high level overview, we definitely do accept IRA funds. The what has to happen with that segue is that you need to use an approved custodian for your IRA investments. And if that's going to be something that you're interested in, what I would say, and we'll tell people at the end of this, is to go ahead and reach out to us so we can walk you through what that looks like to use a self-directed IRA and go ahead and transfer some of your funds from a retirement account into a self-directed custodian, an approved one that we are working with, and then you could invest through retirement funds. So that's absolutely an option as well.
Perfect. As far as the investment mechanics go, do we have a way to explain the waterfall distribution model?
Yeah, that's a great question. Let me just go ahead and show everybody kind of how the mechanism works for them getting their money back. Let me pull that up. Okay, there we go. So for us at King Operating, we don't take a manager's fee. We don't take a management fee yearly. This is what it looks like when we would say money comes out of the ground or when oil is sold. Where does that money go? Right. So number one, it's going to go to royalty owners and mineral interests. Right. So that is whoever owns technically the land that we're drilling on, even though we own it. we own the land in perpetuity, but we pay the royalty owners, right, of that land. So that's the first bulk of where it goes. And then any lease operating expenses. So, of course, wells, if they have an issue and they need repair, something needs to be done, those are the lease operating expenses. And then we have what goes to you. Now, 80% will go to the investor, 20% goes to King Operating until your initial investment is returned. And then we go to what is like a waterfall split in real estate. Many people are familiar with this if they've been in real estate. And that means 60% goes to the investor and 40% goes to King. And so you can see King is actually incentivized here. We want to get you your money back. We want to get revenue going. We want to get growth going because this is where we also make some of our profit back. So this is how you can assess, what portion is going to you, what is going to King, and where that money basically goes.
Perfect. So when we talk about return of capital, is that return of just what was invested, correct?
Well, you have right here 80/20 is going to be the return of your initial investment. So that's the capital you invested, right? So that's going to
Mhm.
be your 200,000 going back to you. Once you get that back, yes, everything else that's coming back is a 60/40 split, but on top of that, you have that multiple that we're targeting. We're targeting that
Correct.
2 to 3x multiple. That's what we really want to see happen. So it's not just about getting your initial investment back, right? We want
Correct.
to get you $500,000 back. That is what we are aiming for with our investments, especially in COP3, which with the assets that we have, how production is going, the amount of oil and hydrocarbons we're producing, we're right on track for that.
Got it. And so the goal, what's a good timeline to shoot for getting that multiplier back?
Mhm.
Would you say 3 to 5 years, or
Yeah,
what's
we always say our target is 3 to 5 years. Now, if we had a great opportunity to sell and divest early, we would absolutely do it, whether that was for maybe it was a couple of our J units that are in the Bivens branch. So maybe a portion comes back to you in year one and year two. So you're seeing a faster return of capital, but we would target that 3 to 5 years to say, 2 to 3x.
so in the best case scenario, you could get your return on initial investment
Yep.
and then 60% until the sale, and then the multiplier at the time of the sale?
Yes, absolutely. And I'm going to actually scroll right here because this kind of gives what I call the three pillars of value at King Operating. So, number one, of course, the tax deduction, which comes out to be 100% over the life of the partnership. But what I said earlier, about 80 to 85% year one, you're taking the bulk of that. And then our monthly distributions, we target the 9 to 14% annualized returns. We're already right on track for that at about 11. New wells are going in. We have 2 new wells that will be drilled and fracked. Those should be coming online in May. And then we'll be seeing about 10 to 12 more wells in this fund. So we're very happy about the distributions going back. And then again, as we just talked about, 3 to 5 years, looking at that 2.8x multiple of at least 500,000, if not more. Because I will mention these projections are based on $70 oil.
Sure. So the higher the price of oil, the better it is for the investors,
Absolutely.
essentially.
Yep.
Well, this has been very educational, Rachel. So thank you for sharing in such detail. And I'm hoping that this is pretty good information for all our audience. And this has been really great getting to know the mechanics and how the math is mathing for oil and gas investments. And so appreciate you having being on the show and sharing that.
Mhm. And can I just say, I want to mention
Yes.
something. That if
Yes.
anybody is out there watching and they would like, you can see it behind me as well. But if they would like a copy of our Jay Young's book, our founder and CEO, The Upside of Oil and Gas Investing, they can go to our website, right? Kingoperating.com. And at the bottom, just scroll down to the footer and it says learn or learn more or fill in that information. And what we can do is use your code growth amped. Make sure you put in, how did you hear about us? Put in growth amped. I'll get a hold of you. I'll get your address and we'll send you a free copy of this book also that so you can learn a little bit more about our model and what makes us different.
Thank you. And we will be adding the links in the description of this video, along with Rachel's email address as well. So if you're an accredited investor and you're interested in exploring this opportunity further, you can get in touch with Rachel directly, and there will be a calendar link too. So you can
Perfect.
schedule a one-on-one call and get right in the action.
That's
So
perfect. Yes, definitely reach out to me. Would love to have a one-on-one conversation and just share more about the opportunity, how it can benefit you. your wealth building strategy, hopefully save you some money in taxes. This is what people have complained about with certain wealthy individuals. Oh, they don't pay taxes. Well, that's because they use these strategies. They take their tax liability and they turn it into a wealth building strategy that now is saving them money and making them money. So let's get you saving some money in taxes.
Absolutely. Use the tax codes as they were intended.
That's right. That's right. Absolutely.
Well, it's been amazing having you on the show and just kind of helping us launch this first financial podcast. So thank you so much for making time to be on the show and hoping to uh, get COP3 to the target across the finish line here in
Right.
the next few months.
Absolutely. Yes, we're very excited about that. And like I said, it's the perfect storm for oil and gas investing right now. Sometimes things just come together that you don't expect. Our fund was already on track, already doing amazing, and then all of a sudden, $100 oil. I mean, not that I'm happy about the war, but I'm just going to say this: sometimes people have to profit out of chaos, and might as well be you.
Absolutely. Thank you so much, Rachel.
Thank you so much,
Ple-
Ion. I appreciate it.
a
Thank
pleasure
you.
having you. Thank you.